Hello everyone, I'm Sudha Udaya. Welcome to today's unit in the Building and Construction Programme. Before we begin, I want to remind you of the purpose of this programme. Each unit is designed to give you the knowledge, skills and industry behaviours required to become a competent and confident building practitioner in Australia. Throughout this course, I'll be drawing on more than 30 years of hands-on experience in residential and commercial construction. My goal is to connect the theory directly to real project situations, showing you how the National Construction Code, Victorian regulations, WHS requirements, and industry standards apply on actual work sites. As we move through each topic, think about how these principles translate into the decisions builders and site managers make every day. By the end of each unit, you should feel more prepared to apply these concepts in practical, safe, and compliant ways on the job. Let's get started. Today's session is Module 3, Volume 1, Section 2, Manage Business Finances. In this module, we are going to take a deep dive into how a construction business plans, manages and controls its finances to maintain profitability and long-term sustainability. Managing business finances is not just about recording numbers, it is about understanding where money comes from, where it flows, and how financial decisions affect the entire business life cycle. As builders, site supervisors, inspectors, and future construction managers, financial literacy is one of the most essential capabilities you must master. When finances are mismanaged, even the best project can collapse. But when finances are well structured, even a challenging project can become an opportunity for growth and business expansion. Today, we will cover revenue streams, expenses, direct labour, overheads, project costing, progress payments, scheduling, cash flow management, record keeping, and much more. By the end of the session, you should understand how financial decisions influence the health of a construction business and how to implement systems that protect profitability. A revenue stream is simply the income a business earns from its operations. In construction, understanding your revenue streams is the foundation of financial management. Revenue can come from various sources, such as residential builds, renovations, extensions, commercial fit-outs, inspection services, consultancy, maintenance contracts, or subcontracting work. The key point here is that your revenue streams must always be clearly defined and measurable. A business with a single revenue stream is highly vulnerable to market fluctuations, economic downturns, and seasonal changes. Diversified revenue streams give resilience, stability, and greater control over financial outcomes. When evaluating revenue streams, we consider the predictability of income, the profitability of each revenue source, the time required to deliver services, the return on investment associated with each type of project. A well-managed builder or contractor always monitors which revenue streams are performing well and which may need adjustment. Next, we move on to expenses. Expenses are the costs the business must cover in order to operate and deliver projects. These include materials, labour, permits, insurances, administrative expenses, utilities, equipment hire, depreciation, subcontractor payments, and more. Understanding expenses is essential because profit is calculated only after expenses are deducted from revenue. Businesses often run into trouble not because they lack income, but because they fail to control their expenses. In construction, expenses fluctuate depending on market conditions, supply chain issues, workforce availability, and project complexity. A disciplined financial manager analyses expenses in detail, categorizes them correctly, and forecasts future expenses in the project budget. This helps avoid financial surprises and protects cash flow. Direct labour. Direct labour refers to the wages or costs of employees and subcontractors who are directly involved in producing the project. For example, carpenters, concreters, bricklayers, tilers and electricians working on the job site all fall under direct labour. It is essential to accurately calculate direct labour because it forms a large part of the project cost. Underestimating labour can lead to reduced profit, while overestimating can price you out of the market. Labour must be allocated correctly to each project, and variations must be updated as soon as they occur. A good financial manager considers not only hourly rates, but also allowances, overtime, superannuation, site conditions, weather delays, and productivity rates. Even minor miscalculations can accumulate into major financial losses across multiple projects. Profit. Profit is the reward for risk. It is the amount left after deducting all expenses from revenue. If a business cannot consistently generate profit, it cannot grow, invest in new equipment, train staff, or survive tough economic periods. In construction, profit margins can vary widely depending on the type of project. Residential construction often works on moderate margins, while commercial projects may produce higher returns but require more capital and carry more risk. Profit is not determined at the end of the project. It must be planned at the beginning. Every project estimate must include a planned profit margin, and the financial manager must track profit throughout the project life cycle. Case study: profit. Let's consider a simple example. A small renovation project brings in $50,000 revenue. The direct labour is $15,000. Materials cost $20,000, and overhead allocation is $5,000. That leaves a profit of $10,000. In this scenario, the business made a 20% profit margin. But imagine if labour was underestimated by just $3,000, or if material prices suddenly increased by $2,000. Profit shrinks quickly. This example reminds us that accurate forecasting, ongoing monitoring, and disciplined cost control are essential for maintaining profitability. Project costing. Project costing is the process of identifying all costs involved in delivering a project. This includes labour, materials, machinery, subcontractors, compliance requirements, permits, insurances, and overhead allocation. Proper project costing ensures the business can price the project accurately, allocate resources effectively, maintain profitability, avoid disputes with clients, monitor financial progress throughout the project. A poorly costed project often leads to disputes, cash flow problems, and loss of confidence from clients and subcontractors. Project costing and overhead allocation. Overheads are indirect costs that cannot be directly linked to a single project. These include office rent, administration salaries, vehicles, insurance, software, marketing, and tools. Overhead allocation spreads these costs across all active projects to ensure each one contributes to the general operating costs of the business. Without proper allocation, the cost of running the business is absorbed unevenly, causing inaccurate financial reporting. A professional construction business applies consistent overhead formulas to each project. Overhead allocation. There are several methods of allocating overheads: percentage of project cost, percentage of labour hours, fixed overhead allocation per project. The chosen method must reflect the nature of your business and must be applied consistently across all projects. Allocating too much overhead can make a project too expensive. Allocating too little can mean the company is not covering its real costs. Effective overhead allocation ensures the business remains profitable even when multiple projects run simultaneously. Review project budgets. Reviewing project budgets is essential. A project budget is not a static document. It is a dynamic financial plan that must be updated as the project progresses. Effective budgeting includes forecasting expenses accurately, tracking actual versus planned costs, identifying budget overruns early, adjusting financial strategies as needed. A skilled financial manager continuously monitors each project stage and adjusts budgets to align with real-world conditions. Scheduled progress payments. Progress payments are scheduled payments made by the client throughout the construction process. They help the builder maintain cash flow and ensure the project moves forward. A progress payment schedule must align with the building contract, the construction schedule, and the completion of specific milestones. Correct scheduling avoids disputes, delays, and financial pressure. Cash flow must be timed with expected progress payments to ensure the business can pay suppliers, subcontractors, and staff. Contract terms on progress payments. Every progress payment must comply with the terms set out in the contract. Typical contract terms include how progress is measured, when payments are due, penalties for late payment, procedures for making a payment claim, rights and obligations of both parties. Understanding contract terms is vital because progress payments are legally enforceable. Incorrect claims or misunderstandings can lead to disputes and financial strain. Laws on progress payments. Progress payments in Australia are governed by strict legislation under the Building and Construction Industry Security of Payment Acts. These laws ensure contractors and subcontractors receive payment in a timely manner and provide a structured process for resolving payment disputes. The laws outline how payment claims must be made, how payment schedules must be issued, the rights to adjudication, the timeframes for payment. Understanding these laws is essential for protecting your business. Scheduling. Scheduling is the systematic planning of tasks over the life of a project. A well-developed schedule helps manage resources, control costs, monitor progress, and maintain cash flow. A construction schedule must include all tasks and milestones, start and end dates, dependencies between tasks, resource allocation, estimated costs per task. Scheduling is not just a project management tool. It is a financial tool that affects cash flow and profit margins. How to prepare a construction schedule. Preparing a construction schedule involves several steps. Identify all activities required to complete the project. Estimate the duration of each activity. Identify task dependencies. Allocate resources and labour. Map out the sequence of work. Assign costs to each activity. A well-prepared schedule is essential for generating accurate progress payment claims, allocating expenses, and protecting the financial stability of the business. Preparing and setting up the construction schedule template. A construction schedule template provides a structured format for managing project timelines. It should include columns for activities, dates, labour, materials, subcontractors, estimated costs, actual costs, and variance. The template must be updated regularly as the project progresses. This ensures financial reports reflect current conditions. Case study: allocating expenses. Consider a small builder constructing a 3-bedroom house. Expenses include materials, site preparation, labour, engineering fees, and overhead allocation. When expenses are allocated correctly, the builder can see exactly where money is being spent and whether the project remains within budget. If expenses are not allocated correctly, the business may appear profitable on paper but lose money in reality. Manage cash flow. Cash flow is the lifeblood of any construction business. Even profitable companies collapse when they cannot maintain positive cash flow. Managing cash flow involves ensuring progress payments are received on time, paying suppliers promptly to maintain good relationships, scheduling subcontractor payments, forecasting income and expenses, maintaining a cash reserve for emergencies. A well-managed cash flow system ensures the business remains stable throughout the project. Cash flow status report. A cash flow status report summarizes the financial position of a project, detailing income received, expenses paid, outstanding invoices, and projected cash flow. The report should be updated weekly or fortnightly to provide an accurate financial snapshot. It helps the business monitor trends, identify risks, and make financial decisions. Keeping track of cash flow template. The template for tracking cash flow must include opening cash balance, Cash inflows for the period. Cash outflows for the period. Net cash movement. Closing cash balance. A clear, easy-to-read template ensures the builder can respond quickly to financial issues. Format and structure of a cash flow status report. The structure of a cash flow report typically includes revenue for the period, expenditure breakdown, overheads, net position, forecast for coming weeks, notes on potential risks. This format ensures financial transparency and supports decision-making. Payment claim. A payment claim is a formal request for payment under security of payment legislation. It must be correctly formatted and must include identification of the work completed, the amount claimed, the reference date, details required under the contract. Submitting an incorrect payment claim may lead to rejection or delay. Receipt. A receipt is proof that payment has been made. Businesses must issue receipts, store them, and record the transaction in their bookkeeping or accounting system. Receipts form part of the taxation records and are essential for audits. To summarize today's session, financial management in construction is a structured, disciplined process. We began by exploring revenue streams and understanding the difference between income and expenses. We analysed direct labour, overheads, and how these influence project costing and profitability. We discussed progress payments, legal obligations, and how payment schedules protect the builder's financial stability. We then explored construction scheduling and how accurate planning supports cash flow. We looked at cash flow status reports, templates, payment claims, and receipts, all essential documents that ensure the business remains legally compliant and financially sustainable. Ultimately, financial management is not just about numbers. It is about building confidence, protecting your reputation, ensuring your business survives challenges, and positioning yourself for long-term success. Don't forget, our LMS contains interactive learning video series. Please watch them as part of your study and link them to today's session. To support your study, we've introduced the AI Playbook. This tool simulates assessment questions and provides guidance. You can access it from your assessments. Thank you for joining me today. I'm Sudha Udaya, and I look forward to seeing you in the next lesson.